This is Nightly Business Report with Sue Herrera and Bill Griffin.
Monday blues. Stocks sell off as investors are rattled by trade tensions, even as the White House tries to walk it back. Economic momentum. Optimism is at a record. New home sales surging. But is the red-hot economy too hot? Moving out, Harley-Davidson is shifting some production overseas, and the American icon is blaming tariffs. Those stories and more tonight on Nightly Business Report for Monday, June 25th. Good evening, everyone, and welcome. Bill is off this evening. It was a rough way to start the week. The Dow fell sharply, recording its ninth decline in the past 10 sessions. Roughly half of the S&P 500 sectors closed in correction territory. Even the beloved tech sector got hit hard as trade anxiety spread through the market and unnerved investors. The Dow Jones Industrial Average dropped 328 points to 24,252. The Nasdaq was down 160, or more than 2%, and the S&P 500 fell 37. Bob Pisani has more on today's sell-off from the New York Stock Exchange.
Stocks sold off as trade tensions rose again today, with the Dow erasing all of its gains so far in June and ending just about in correction territory. We're almost 10% from record highs. It was risk off all day, with the usual crop of industrial stocks and materials down. Those are trade worries. That happens all the time. But the damage was a little bit broader than that today. Today also gave investors an excuse to take profits on some of those overheated names. Netflix, for example, fell 7% today after surging more than 100% so far this year. Netflix isn't in China, so there's clearly a broader rotation going on here. Other FANG stocks like Amazon, Facebook, Alphabet, they were all down about 3%. Other big momentum names like Alibaba and Nvidia and Baidu and Twitter, they were all down mid-single digits. Even the small cap Russell 2000, which had been relatively immune to these trade war worries, dropped almost 2%. Now, a new twist was thrown into the trade war saga when the Wall Street Journal reported that President Trump might curb Chinese investments in U.S. technology. Chip stocks suffered their worst single-day decline in 2 months, and a basket of momentum stocks, ticker SPHB, has now fallen more than 4% over the last 2 weeks. Stocks came off of their lows, however, late in the day when the president's National Trade Council director, Peter Navarro, told CNBC that the White House had no plans to impose investment restrictions. It's not clear what he means or whether this contradicts the president's statement. That's part of the problem we've got. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So where does the president's strategy on trade actually stand? Kayla Tausche tries to make sense of the latest twists and turns.
President Trump is considering limits on China's ability to invest in the U.S. tech sector, setting a deadline to introduce such limits by this week. In a tweet, Treasury Secretary Steven Mnuchin said the statement would not be specific to China, but White House trade advisor Peter Navarro said that's not the plan.
The only thing that's going to happen in the near term is on Friday, the Treasury Department is going to report to the president about the issue related to China. That's all that's going to happen. And with respect to other countries, there's absolutely nothing on the table.
Fears are growing that the Chinese will hit back hard, disrupting U.S. businesses by delaying deals and licenses, holding up cargo at the ports, or even devaluing its currency.
We are tethered at the hip with China in many different ways, and they have many different tools they can use to fight back.
President Xi warned Western CEOs in Beijing last week it would strike back, criticizing the U.S. and calling on companies to take the road of reform, opening up innovation and development, and not to go backward to isolation, inflexibility, protectionism, and unilateralism. Chinese investment in the U.S. has already fallen. Foreign direct investment is down to just $1.8 billion in the first half of the year. That's down more than 90% from the same time a year ago. Hopes that a deal will be worked out are fading.
We're probably now living in the new norm, that these tariffs are likely to go in place. They're likely to stay in place. The investment restrictions are likely to go in place and stay in place.
Economists at Goldman Sachs say the proposed tariffs only pose a modest risk to growth, but the risk of escalation is far greater. For Nightly Business Report, I'm Kayla Tausche in Washington.
So as investors watch the trade back and forth, how much more selling can we expect? Paul Schatz is president of Heritage Capital. Paul, good to see you. Welcome back to the program.
You too, Sue. Thanks.
I think it's probably pretty obvious that we should expect volatility, certainly, but where do you think we stand in terms of the cycle of the market and the sell-off?
I think, listen, the Dow and the S&P saw their peak on January 23rd. Don't forget the other parts of the market already made new highs this quarter. So most of your watchers are probably looking at the Dow and the S&P, which are masking some underlying strength because we really have the market's been in good shape. I think this selling is a very short-term little bout of weakness, and I think it wraps up in the next, 5 to 7 trading days. And then I think the next quarter, which begins on Monday, I think we're going to see the Dow hit at least 27,000. So I think short-term pain, intermediate-term gain. Tech went so far so fast, but I don't think the run is over. It may cede some leadership, so other things may lead, but I don't think the tech bull market is over yet.
So if you are a longer-term investor and you see a day like we saw today, do you use that opportunity to go in and add to positions or look for new positions? Because you are bullish longer term.
I am, and I think the long-term investor should view a day like today as somewhat just noise. It's really just short-term noise. Don't forget, the Dow is 24,000. So 300 points in the downside really doesn't mean a whole lot. But if a long-term investor had some cash, I would start looking at the value names, which would be the more beaten up ones. I would not, if I was a long-term investor, I would not look at the FANG stocks. I think even if they continue to go up, they certainly have more risk than some of the names that have been under pressure this year. So I look at stuff that hasn't gone up yet. Maybe even go into consumer staples, which would be like the supermarkets, the soaps, the Colgate, Clorox, Procter & Gamble, the pharmaceuticals, the Mercks, the Pfizer, stuff like that, even the regional banks. I mean, I don't want to chase the stocks that have had these meteoric rises so late in the bull market. I want to find the stuff that has some value, is not overly expensive, and probably is going to pay some good, healthy, solid dividends for that long-term investor.
All right. On that note, Paul, thanks very much. Appreciate it.
Thanks, Sue.
Paul Schatz with Heritage Capital. To the economy now, and a surprising surge in new home sales. Purchases of newly built single-family homes grew a lot more than expected last month, and the rise comes despite high prices and low home inventory. But there's a catch. Diana Olick has the details.
Home builders didn't start more homes in May compared to April, but they did sell more homes. Sales of newly built homes jumped a wider than expected 6.7% after April's read was revised down. And there was one more devil in the details.
All the growth in housing, new home sales, is in the South, where housing is affordable. And that has implications going forward. If interest rates tick up sharply, will it not even be affordable in the South?
Sales jumped dramatically in the South, which is where builders are busiest and prices are lowest. That may be why the median price of a newly built home, which has been rising consistently, actually dropped 3% in May compared to a year ago. Builders are not really focused on lower-priced homes because they can't make as much money on them, especially as the costs for land, labor, and materials continue to rise. Mortgage rates continued their charge higher in May, and while they didn't seem to hurt much in the South, they likely contributed to the drop in sales in more expensive regions like the West.
The bottom line is that they're going to hurt sales going forward. The good news is that they probably aren't going to go up that much more.
Interest rates may not go up a lot more, but they will continue to edge higher. Meanwhile, prices for existing homes continue to rise sharply, and builders are certainly not lowering their prices. Added up, and housing just continues to get more expensive. For Nightly Business Report, I'm Diana Olick in Washington.
And that strong housing market may be contributing to a rise in economic optimism, which, according to the latest CNBC All-America survey, is at a record. Steve Leisman breaks down the results.
American economic optimism hitting a new record in the 10-year history of the CNBC All-America Economic Survey, with 54% of the public saying the economy is good or excellent, and a record low 43% labeling it just fair or poor. It's small, but it's also the first time that the percent of Americans calling the economy excellent, now at 13%, has outstripped those calling it poor at just 11%. Those saying the economy will get better is down a bit, but CNBC pollsters say that's what you'd expect when views of the current situation are so strong. The positive economic views are helping the president, with 51% approving of his handling of the economy. It's the first time during the Trump presidency that he's gained majority approval on the measure. Still, just 41% approve of the overall job he's doing as president, up just 2 points from March. However, the percent of Americans disapproving has fallen by 10 points. That could be a sign of disagreement with the president on other issues outside the economy. The poll shows Americans are bullish on expected gains in their home values and that the rise in gas prices hasn't affected their driving habits very much. Confidence in stocks has fallen while the market has turned pretty much sideways this year, but it remains above its long-run average. 42% say now is a good time to invest, and 29% say it's a bad time. The smartest of all may be the record 31% who say they just don't know. For Nightly Business Report, I'm Steve Leisman.
While the latest data is indeed solid, is the economy on the brink of running a bit too hot? And will trade tensions cool things off? We're joined now by Craig Dismuke, the chief economist at Vining Sparks. Craig, good to see you again. Welcome back.
Hey, good evening, Sue.
Let's get the trade discussion out of the way. What type of impact do you think the current trade dispute or tariffs might have on the economy?
We think it'll be fractional. The biggest fear, obviously, is that this escalates from here. If you look at the trade tariffs that have been put in place so far, the impact to growth should be very minimal. The impact to inflation should be very minimal. Those are the two things we really look at as far as their impact to the economy. And so, as long as they don't escalate, into a trade, as long as it doesn't escalate into a trade war, then we think the impact will be fairly small.
But you do think that the Fed might have a bigger impact net on the economy, and something that investors should watch. Why?
Well, based on the previous stories you just discussed, the economy is very strong right now. And if you look at the consumer, the unemployment rate's down to 3.75%. Job openings are at the record high level. Consumer confidence is as high as it's been in almost 20 years. If you look at the business sector, businesses are as confident as they've been going back to 1973. Their outlook for sales is very strong. If you look at the government sector, we now have a fiscal boost coming from the increase in the spending caps. Global growth has been very strong. And so you've had this confluence of events where everything has become a tailwind. And so the Fed looks at this scenario and they've become more hawkish. We've seen them hike rates already. And now they're going forward. They're projecting more hikes, and so that is in their last Fed meeting. They announced that in their projections they projected 2 more hikes this year instead of just 1. And so you see them becoming very slowly a little bit more hawkish. And so it looks like we're towards the later end of the cycle. And as the Fed is hiking, I think that has the potential to really point to the end of the cycle.
In other words, they might hike rates just a little bit too much. They might tighten too quickly.
Well, that's the risk, and especially if they become concerned about inflation. And right now, inflation continues to be fairly moderate. But if they start to become too concerned about it, that's what happened back in '89, 2000, 2006. When you look back at their statements, they were concerned about inflation, and so they hiked rates through longer-term rates. And once that happens, that typically is an indicator that you're going to have a recession.
On that note, Craig, thank you so much. We will be watching. Craig Dismuke with Vining Sparks. It is time to take a look at some of today's upgrades and downgrades. Microsoft was upgraded to overweight from neutral at Atlantic Equities. The analyst says Microsoft has successfully managed its transition to a cloud-based company. The price target is $125, and on this down market day, shares of Microsoft fell 2% to $98.39. Fellow Dow component Intel was downgraded to neutral from buy at Nomura Instinet. The analyst there cites last week's abrupt departure of the CEO, Brian Krzanich, as well as uncertainty about the chipmaker's longer-term prospects. The price target, $55. The stock dropped 3% to $50.71. Kroger was downgraded to hold from buy over at Pivotal Research. The analyst cites the stock's valuation following a 17% gain over the past month. The price target is $31. The stock fell 1% to $29.33. Still ahead, women get behind the wheel in Saudi Arabia and steer their way to economic opportunity. The Supreme Court handed American Express a legal victory. American Express has a policy of not allowing merchants to encourage customers to use other lower-fee credit cards. The High Court ruled that policy does not violate antitrust law. The decision validates a key component of American Express's business model, and that sent the shares higher by more than 1%, making it one of the best-performing stocks on the Dow Index today. Investors slammed the brakes on shares of Harley-Davidson today. That after the motorcycle maker said it is moving some of its production out of the United States. The reason? To avoid those new tariffs in Europe that will jack up the cost of selling Harleys in that continent. It's an example of the fallout from the Trump administration's brewing trade war with Europe. Phil LeBeau has more.
Harley-Davidson is hurting. The motorcycle maker, already struggling with slower sales in the U.S., is now facing a big hit due to tariffs in Europe, its second largest market. The EU is raising tariffs for U.S.-built motorcycles from 6% to 31%. So the average Harley sold in Europe will cost another $2,200, a $90 to $100 million hit to the bottom line annually. As a result, Harley is shifting some of its production overseas. The company says, "We are currently assessing the potential impact on our U.S. facilities. We are hopeful the U.S. and EU governments will continue to work together to reach an agreement on trade issues and rescind these tariffs."
Things have actually moved against them in a number of ways, and thus far, the Trump economy has not been very good for Harley-Davidson.
For President Trump, Harley-Davidson moving some production out of the U.S. paints a far different picture of the company he's embraced and praised publicly.
So thank you, Harley-Davidson, for building things in America. I think you're going to even expand. I know your business is now doing very well, and there's a lot of spirit.
Outgoing Speaker Paul Ryan, whose district borders Harley's headquarters in Milwaukee, reacted to the news saying, "This is further proof of the harm from unilateral tariffs. The best way to help American workers, consumers, and manufacturers is to open new markets for them, not to raise barriers to our own market." This is just the latest headwind for Harley-Davidson. Business has been slumping here in the U.S., where it sells almost 2/3 of its bikes, while competition has stiffened in Asia, where the company is preparing to open a new plant in Thailand. And in the next 2 years, Harley-Davidson plans to expand its production overseas, which in theory could help it limit the cost of tariffs, all while diversifying its manufacturing footprint. Phil LeBeau, Nightly Business Report, Chicago.
Shares of Carnival sink the most in more than 2 years, and that's where we begin tonight's market focus. The cruise line operator slashed its full-year guidance, blaming rising fuel costs and unfavorable currency exchange rates. But the CEO says the company should get past that.
The market is reacting to a lowering of guidance from the March guidance. That's still higher than the original guidance for the year. We are offsetting a 19-cent drag in fuel and currency, or mitigating it. And so that resulted in a lower guidance for the rest of the year. But the reality is that that's all that's going on. And of course, we're going to work hard to beat that.
Shares of Carnival fell just about 8% to 58.54, and that dragged cruise operators Norwegian and Royal Caribbean lower by more than 5% each in today's trading. General Electric is selling its industrial engines unit to private equity firm Advent International for $3.25 billion. That move is part of the company's plan to streamline and sell $20 billion in assets by the end of next year. Last month, GE sold its railroad unit for about $11 billion. GE was off more than 2% to $12.75. Kraft Heinz is reportedly interested in buying Campbell's Soup, but the report in the New York Post did not say if Kraft had hired a bank to explore the option, which is usually a precursor to talks. Nonetheless, investors ate it up, sending Campbell's up more than 9% to $42.23 and Kraft Heinz up a fraction to $63.32. AT&T is buying digital ad company AppNexus for more than $1.5 billion. The move allows AT&T to better compete with Google and Facebook for ad dollars, since AppNexus is one of the biggest digital advertising platforms. Shares of AT&T rose 2 cents to $31.71. Well, yesterday, history was made in Saudi Arabia, where women were allowed to drive for the first time. Saudi Arabia had been the only remaining country where women had faced fines and arrests for driving. Hadley Gamble is in Riyadh with what women behind the wheel might mean for that kingdom's economy.
Today, women in Saudi Arabia can finally drive.
I am very, very happy.
It's just the latest move by the country's crown prince to transform a traditional society into a 21st century economy.
Saudi Arabia has come a very long way, actually. Right now, with the new Vision 2030 that we have in place, with His Royal Highness announcement 2 years ago, we've seen things accelerating significantly.
But today, Saudi women make up just 22% of the country's total labor force, with the government hoping to boost those numbers to 30% by 2030.
And while the government hopes that putting women behind the wheel will finally cut down on an over-reliance on foreign labor, they also hope it means added economic opportunity.
Regional ride-sharing service Careem was one of the first companies to get on board, aiming to sign up as many as 20,000 female drivers by 2030.
You decided to become a captain for Careem?
Yeah.
Why?
Why not? Because I can do it. Women have been ready for that challenge for quite some time because women have been slowly integrated into the workforce. I mean, in every field, you see women now.
It's breaking down barriers, isn't it?
It is.
And while those rapid reforms have finally put women in the driver's seat, questions remain over how quickly the Saudi vision can deliver. For Nightly Business Report in Riyadh, I'm Hadley Gamble.
Coming up, how a startup is using food therapy to defeat diabetes. Here's what to watch for tomorrow. Housing grabs the spotlight with the release of the April S&P CoreLogic Case-Shiller Index, and the market will be looking to see if home prices picked up during the spring selling season. We will also get a look at manufacturing in the Mid-Atlantic region when the Richmond Fed's June index comes out, and we'll see how the consumer feels about the economy when the Conference Board posts its latest confidence index. And that's what's to watch for tomorrow. The man in charge of the new healthcare venture established by Amazon, Berkshire Hathaway, and J.P. Morgan wants to see waste in the system reduced. Speaking over the weekend at the Aspen Spotlight Health Conference, Atul Gawande appears to be focused on the middlemen.
One source of waste is our very high administrative costs, and there are a lot of middlemen in the system, and there have to be solutions that simplify that, take some of the middlemen out of the system. Second, there has to be solutions around pricing. That's another bucket. But the biggest bucket is misutilization. Often it's meaning the wrong care at the wrong time in the wrong way. We have the wrong care pushing out the right care.
The venture will initially seek to improve care for the 1 million individuals who get their insurance from Amazon, Berkshire, and J.P. Morgan. If successful, the blueprint could become available to other companies as well. Diabetes is the nation's 7th leading cause of death, and while diabetes medications are big business for the drug industry, the disease is still on the rise. But as Meg Terrell tells us in tonight's Modern Medicine, one Silicon Valley startup is trying to build its business model around food as medicine.
An elite triathlete, Sami Inkinen, was shocked when he discovered he was pre-diabetic.
I thought, this is absolutely nuts. Nobody can exercise more than I do, and you can't be leaner than I am.
Inkinen found success with the ketogenic diet, a high-fat, low-carbohydrate way of eating. The co-founder of real estate company Trulia, Inkinen spun his own experience into a new company called Virta Health.
Now those look good.
Virta works with patients like 68-year-old Gary Moore. Diagnosed more than 5 years ago with diabetes, Moore was dependent on insulin to control his blood sugar.
Keep that A1C down. No more diabetes for Gary.
I still can't believe it.
Now he works with a Virta doctor and coach through an app, texting, and video chats to change his eating habits.
All my life, I've eating what I wanted to eat. What I eventually found after about 6 or 8 months of trying is that I was overeating.
Since he started almost a year ago, Moore says he's lost more than 50 pounds and his blood sugar is under control, so much that he's been able to stop taking insulin. Inkinen says 60% of patients reverse their diabetes on Virta's program. More than 90% of those on insulin can reduce or stop taking it.
So it's absolutely transformative results.
With those results come cost savings, $9,600 on average in the first 2 years in drug and medical costs. The program costs $370 a month out of pocket, unless it's covered by employers or insurers. For Gary Moore, it's been worth it.
It saved my life. So what is your life worth?
For Nightly Business Report, I'm Meg Terrell.
And before we go, here's another look at the sell-off on Wall Street today. The Dow dropped 328 points. The Nasdaq was down 160 or more than 2%, and the S&P 500 fell 37. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening, and we will see you tomorrow.